For 8 intense days, the world's financial heartbeat skipped a beat. It started in Asia, first as a whisper, then as a roar that echoed across the globe. It all began when trading activity on major Chinese exchanges, including the massive Shanghai Gold Exchange, suddenly slowed to a crawl. At first, it was just operational pauses, delays, and widening spreads. But global investors knew something was wrong. Within hours, a wave of panic rippled from Shanghai to New York City, shaking bullion vaults in London and rattling retail trading apps all over America. What unfolded next was 8 days of pure chaos in the gold and silver markets. It was a financial shockwave that laid bare just how fragile and interconnected our global system has become. Day 1 began with a strange silence. Traders noticed delays. Bid-ask spreads widened. Prices hesitated. Now, you have to understand, China isn't just another player in precious metals. It's one of the world's largest consumers and producers of both gold and silver. When Chinese trading slows down or stops, the entire pricing mechanism of global bullion begins to tremble. And tremble it did. Within hours, gold futures spiked. Silver, always the more volatile of the two, went absolutely wild. On Wall Street, traders scrambled into safe haven assets. The New York Stock Exchange opened with sharp defensive moves. Mining stocks surged while tech stocks dipped. The US dollar wavered. A single question echoed through every trading desk. Is this just a temporary glitch, or the beginning of something much, much bigger? By day 2, the tremors had become a full-blown earthquake. With Chinese market participation practically gone, liquidity in the physical gold market tightened dramatically. Premiums on physical gold shot up. Delivery times got longer. Institutional buyers, the big fish, started scrambling to secure their allocations. And silver? It became the epicenter of speculation. Analysts on every financial network were debating the cause. Was this a strategic move by Beijing, a new regulatory crackdown, or was it a sign of deeper economic strain within China? On social media, retail investors gave it a name, the 8-day metal freeze. Gold surged past key psychological resistance levels, silver moved even faster, and all the while the People's Bank of China remained completely silent. And in the world of finance, silence is often louder and more terrifying than any announcement. By the middle of the week, the United States was officially in crisis mode, not politically, but financially. Hedge funds piled into gold-backed ETFs. Central banks in emerging markets quietly started adjusting their reserves. Analysts on CNBC described it as the sharpest short-term distortion in precious metals pricing since the pandemic. But this wasn't about a virus. This was structural. The sudden absence of Chinese demand and supply had created a vacuum, and as we all know, markets hate a vacuum. Gold miners in Nevada and Canada saw their stocks rally. Physical bullion dealers reported record-breaking online traffic. Silver coins were selling out at major US retailers. Fear is a powerful catalyst, and fear was spreading like wildfire. By day 5, we entered the conspiracy phase. Whenever markets move this violently, wild narratives always explode. Some claimed China was strategically restricting its exports to manipulate prices. Others speculated about a serious internal liquidity crisis. A more dramatic theory suggested Beijing was secretly accumulating massive amounts of gold while global prices were spiking. None of this was confirmed, of course, but in finance, speculation alone is enough to drive volatility to extreme levels. Futures contracts whipsawed back and forth. Algorithmic trading bots amplified every single headline, making the swings even more violent. US Treasury yields fluctuated as investors tried to hedge against inflation risks. Gold briefly touched levels not seen in months. Silver was jumping by double-digit percentages within a matter of hours. It felt less like trading and more like a financial battlefield. By the 7th day, the pressure was immense. Global institutions were being pushed to restore some semblance of stability. Private bullion banks in London tried to stabilize the spreads. US commodity regulators were closely monitoring derivatives exposure, worried about a cascade of margin calls. Analysts warned that if this disruption continued, it could trigger serious stress across the entire system. But for many retail investors, especially in America, this chaos looked like an opportunity. Search trends for buy silver now and gold shortage spiked dramatically. Influencers on social media declared it the start of a new precious metals supercycle. But seasoned traders, the veterans of the market, remained cautious. They know a simple truth: markets that rise too fast can fall even faster. Then, on the 8th day, a glimmer of hope. Partial trading normalization began in China. Activity slowly started to resume across the key exchanges. Official statements trickled out, suggesting the pause was due to operational adjustments, not a systemic collapse. The market's reaction was immediate. Gold pulled back sharply before finding a new floor. Silver experienced another violent swing before settling into a tighter range. The chaos wasn't permanent, but its impact was very, very real. For 8 days, the entire global pricing structure of 2 of humanity's oldest assets had been shaken to its core by a single country's pause. And that realization changed everything. So what does this all mean, especially for us here in the United States? This episode revealed 3 powerful truths. First, our global dependence is absolute. The US might dominate equity markets, but when it comes to precious metals, pricing is globally intertwined. What happens in a trading hub like Shanghai directly affects retirement portfolios in Texas. Second, gold is still king in a crisis. Despite all the hype around cryptocurrencies and digital finance, when real uncertainty strikes, money still flows into gold first. It's the ultimate safe haven tested by time. And third, silver is the wild card. Silver's dual role as both a monetary metal and an industrial commodity makes it far more volatile. But that volatility also means it can be much more explosive in times of disruption. But this story wasn't just about metal. It was about power. China holds one of the largest gold reserves in the world. The US holds the largest official reserves. Both nations understand that gold isn't just an investment, it is strategic insurance for the entire country. Moments like this force us to ask deeper questions. Is our global financial system too centralized? Could a future disruption last much longer than 8 days? Are central banks around the world quietly preparing for a more fragmented and less predictable economic future? For 8 days, traders and investors got a terrifying preview of what happens when one of the main pillars of the global system suddenly goes dark. The lesson wasn't to panic. The lesson was to be prepared. After the chaos subsided and markets stabilized, something had subtly changed. Investors were more alert, central banks were more cautious, and retail buyers were more aggressive than ever. Gold didn't just crash back to its pre-chaos levels. Silver didn't just forget its wild ride. Instead, both metals settled at a new psychological baseline, slightly higher and certainly more respected. The 8-day disruption became a crucial case study in how quickly our modern, hyper-connected markets can destabilize, and how deeply intertwined the economies of the East and West truly are. In a world of digital currencies, AI trading algorithms, and trillion-dollar tech giants, it took something ancient, gold and silver, to remind everyone of the system's inherent fragility. When China paused, the world noticed. When metals surged, America reacted. And when the system finally restarted, no one forgot how close that volatility came to spiraling completely out of control. 8 days. That's all it took to shake confidence, spike prices, and remind every single investor of a timeless truth. In times of uncertainty, hard assets speak much louder than headlines. And the next disruption? It might not last just 8 days. But price was only the surface. Underneath the volatility in gold and silver lay something more significant, a revealing stress test of the global financial architecture. Those 8 days did not just move markets. They exposed dependencies that few fully understood. The hidden plumbing of global metals, precious metals markets appear simple on the surface. Buyers, sellers, vaults, delivery. In reality, the system is layered. Futures contracts trade in New York. Physical clearing and vaulting centers operate in London. Industrial demand flows through Asia. Refining capacity is concentrated in Switzerland and China. Retail distribution spreads across North America and Europe. When Chinese exchanges slowed, it wasn't just a trading venue that paused. It was a central hub in a tightly wound network. The global gold pricing benchmark may be heavily influenced by futures trading in the United States, but physical demand from China often determines the underlying strength of that price. Remove that participation, and the entire structure shifts. Liquidity is confidence, and confidence depends on constant participation. For 8 days, participation fractured. The comics Shanghai connection. Many retail investors assume gold prices are set solely in New York. In reality, pricing is a feedback loop between East and West. The futures market operated by the CME group in Chicago influences global benchmarks, but so does physical trading in Shanghai. When China's physical market slows, arbitrage flows stall. Delivery expectations change, hedging strategies distort, spreads widen globally. Traders who normally exploit price differences between regions found themselves unable to balance positions efficiently. That breakdown in arbitrage amplified volatility. It was not just a liquidity problem, it was a synchronization problem. Silver, the industrial shock amplifier gold, is monetary. Silver is hybrid. Nearly half of global silver demand is industrial. Electronics, solar panels, medical equipment, batteries. China dominates many of those manufacturing sectors. When uncertainty hit Chinese exchanges, markets didn't just question investor demand, they questioned industrial continuity. That is why silver reacted with greater violence. A gold spike can be driven by fear alone. A silver spike often reflects fear plus supply chain uncertainty. During the disruption, silver's dual identity became a magnifier. Investors piled in for safety, while manufacturers quietly assessed procurement risk. 2 different motives, 1 explosive result. Central banks. We're watching closely. No central bank issued dramatic statements. There were no emergency summits. But silence does not equal inaction. The People's Bank of China had already spent years steadily increasing gold reserves. The Federal Reserve holds the world's largest official gold reserves, though it does not actively trade them in open markets. In moments of stress, gold becomes geopolitical, not speculative. A disruption centered in China likely triggered internal reviews across multiple monetary authorities. Are reserve allocations adequate? How exposed are domestic banks to derivative stress? Could prolonged disruption create settlement risks? Central banks think in decades, not days. An 8-day event is short, but the lesson it provides can shape policy for years. The dollar dynamic during the disruption, the US dollar wavered but did not collapse. That alone is revealing. In past crises, capital often rushed overwhelmingly into the dollar. This time, flows were split between dollar holdings and physical metals. That subtle shift matters. It suggests a growing perception that gold is not merely an inflation hedge, it is a systemic hedge. If disruptions originate from one major economy, investors may no longer assume that fiat currency alone provides safety. They diversify safety itself. The algorithm, factor modern markets, are no longer driven solely by human traders. High-frequency trading systems, momentum algorithms, and AI-based risk models scan headlines and liquidity metrics in milliseconds. When Chinese exchange volumes dropped, algorithms reacted faster than humans could interpret the cause. Liquidity thresholds triggered, volatility parameters widened, stop-loss cascades activated. Momentum strategies accelerated moves. What might once have been a controlled repricing became amplified. Technology increases efficiency, but in thin markets, it can also intensify instability. The 8-day episode demonstrated how digital speed interacts with physical scarcity, a uniquely modern risk layered on top of ancient assets. Mining stocks. The secondary shockwave. While physical gold surged, mining equities experienced amplified gains. Companies operating in Nevada, Ontario, and Western Australia saw capital inflows as investors sought leveraged exposure to higher metal prices. Yet seasoned portfolio managers know that mining stocks are not gold itself. They carry operational risk, political risk, energy cost exposure, labor constraints. When volatility eventually cooled, some of those stocks retraced sharply, a reminder that equity proxies behave differently than the underlying metal. In every precious metal surge, there are primary beneficiaries and secondary speculators. The distinction becomes clear only after the dust settles. Retail America enters the arena. One of the most telling developments was the reaction of retail investors in the United States. Online bullion dealers reported spikes in traffic, coin inventories tightened, social media narratives intensified. Unlike institutional flows, retail buying often responds to emotion. Fear of missing out, fear of shortage, fear of currency debasement. This emotional component can extend volatility beyond what fundamentals justify, but it also signals something deeper: distrust, instability. When everyday investors rush toward hard assets, it reflects psychological hedging as much as financial positioning. The fragility. Question. The most important takeaway from the 8-day disruption is not about price levels. It is about fragility. Modern financial markets are globally synchronized, digitally accelerated, liquidity dependent, confidence driven. Remove one major node, even temporarily, and ripple effects travel instantly across continents. The event revealed how concentrated certain pillars have become. China is not merely a participant in metals markets, it is a structural anchor. What if it lasted 30 days? This hypothetical haunted institutional desks. An 8-day disruption caused sharp volatility. A 30-day disruption could have triggered margin stress across leveraged futures positions, broader commodity repricing, spillover into currency markets, strain on bullion bank balance sheets, possible coordinated central bank responses. The fact that stabilization occurred prevented escalation, but risk models have now been updated worldwide. That is the quiet consequence. The geopolitical undercurrent beyond liquidity and pricing, there is a strategic dimension. Gold remains one of the few universally accepted reserve assets with no counterparty risk. As global trade becomes more politically fragmented, nations may prioritize assets outside another country's control. The 8-day pause reminded policymakers that access matters as much as ownership. A system that relies on continuous global cooperation may face increasing stress in a multipolar world. Gold sits at the intersection of finance and sovereignty. Silver, tied to industrial supply chains, sits at the intersection of technology and manufacturing power. Both are strategic. After the restart, a subtle reset. When trading normalized and prices stabilized, something subtle had shifted. Volatility premiums remained elevated. Physical premiums did not fully revert. Institutional hedging activity stayed higher than average. Markets rarely forget stress events. They internalize them. The 8-day metal freeze may not enter textbooks, But within trading circles, it will remain a reference point, a case study in how quickly liquidity can evaporate. The broader lesson for U.S. investors. For American portfolios, the disruption reinforced several principles. Diversification must be global. Domestic strength does not isolate investors from international shocks. Liquidity is not guaranteed. Even deep markets can thin rapidly. Hard assets retain relevance. In moments of systemic uncertainty, tangible stores of value regain psychological dominance. But perhaps most importantly, interdependence is permanent. The United States and China operate within a shared financial ecosystem, whether politically aligned or not. When one side pauses, the other feels it immediately. Final reflection. A warning. Wrapped in volatility. The 8-day disruption was not a collapse. It was a preview, a demonstration of how tightly wound the global system has become and how quickly tension can transmit across oceans. Gold and silver did what they have done for centuries. They responded to uncertainty. But this time, the uncertainty was not war, pandemic, or banking failure. It was silence. And silence, in interconnected markets, can be deafening. If a temporary operational pause could generate that level of reaction, what might a deeper structural fracture produce? That is the question institutional risk committees are now quietly modeling. 8 days revealed the pressure points. The next disruption, whether in metals, currencies, energy, or digital infrastructure, may test them more severely. Preparedness is no longer optional, it is strategic.